Let's talk about how each of these portfolios stay within that risk range. Right in the middle, the balanced portfolio is for people with a risk score between 40 and 59. Depending on whether we're overweight or underweight different asset classes, the score should always fit within that range. And we accomplish this by setting guardrails for the minimum and maximum of each asset class you can be in. So an example of the balanced portfolio, at all times you'll have at least 25% equities and at most 60% US equities. Same thing with fixed income, minimum 25% into bonds and at most 60% into bonds. And at all times 2% cash. We then use asset class ranks to determine what to do with the remaining money. In this example, we had 48% left. So imagine this cup has 48% of your money. We then take the number one ranked asset class. We then fill that asset class up until it's reached its maximum allowed allocation. We then go to the second, third, and perhaps fourth ranked asset classes until this cup is empty. We've carefully chosen what those guardrails are, what the minimum and maximums are for different asset classes, so that at all times you're within your stated risk number range. If you're a conservative investor, you don't have to worry about if US equities and international equities are top ranked, that your risk score is going to be something keeping you up at night. Or if you're a long-term investor with an aggressive risk score, you don't have to worry about being heavily allocated into conservative investments, therefore missing out on the potential of the long-term gains. This is simply a way that we can overweight or underweight and take advantage of the momentum that exists. Let's take a look at a real-world example on how these asset class ranks work. So August 1st of 2008, which is 45 days before Lehman Brothers filed for bankruptcy, thus signaling the start of the financial crisis. The fixed amount of 52% has already been allocated, 25% into US equities, 25% into fixed income, and 2% into cash. The 48% remaining had to be deployed. Number one ranked was currencies. The maximum we can have in currencies on our moderate portfolio is 10%. Commodities was ranked number two with a 10% maximum. Cash went from 2% up to 25%. So we've already spent 43% of the 48%, therefore leaving only 5% to add to our fixed income and nothing to add to the US or international equities. The associated risk score of this portfolio was exactly 40. So as investors entered the 2008-2009 financial crisis, their risk score was at the minimum of the range they were comfortable with. Let's fast forward 13 months to September of 2009. You might not recall, but March of 2009 was the official bottom of the stock market during the financial crisis. The next several months were extremely choppy, and by the summer, momentum had shifted enough that international equities and US equities were ranked first and second. Recall that we have 52% already allocated, leaving 48% to deploy. The number one ranked international equities was capped out at 25% for our moderate portfolio, leaving 23% to add to the US equities, and nothing for commodities, currencies, fixed income, or cash. This is as risky as our moderate portfolio can be, and the associated risk score was 59, right at the top of the risk score range. Not a bad place to be as we entered the longest bull market in history.